Welcome to Iron Financial. Our mission here is simple. We help you forge a stronger portfolio. We do that by putting companies on the anvil, stress testing their fundamentals, and just cutting right through all the market noise. Today, the company in the forge is Korn Ferry. Now here's the thing. They just dropped what, on paper, looks like a rock-solid earnings report. I mean, a decisive beat. But the market? The market took one look, and instead of a round of applause, it took a sledgehammer to the stock. So the central puzzle we're tackling today is this. Is the market seeing some deep structural cracks that most of us are missing? Or is this a forged steel company that's being sold for scrap prices? It's time to fire up the forge and get into these numbers.
Okay, let's just dive right into the heart of this paradox, because this is what it's all about. On the left, you see the result, a clean beat on earnings. Korn Ferry did better than anyone expected. By every traditional metric you can think of, that is a clear, undeniable win. But then you look over to the right side, and that's where the story gets really twisted. A nearly 5% drop in the stock price. Look, this isn't just a little market twitch. This is a powerful signal. Wall Street is practically screaming that the headline numbers are not the full story. And our job today, as financial engineers, is to figure out precisely what has the market so spooked. Is the foundation of this company truly solid, or did this shiny earnings report just paper over some really serious structural fissures?
All right, here's our blueprint, our game plan for breaking down Korn Ferry today. First, we're going to dissect the numbers behind that core earnings paradox. Then, we'll start building the fortress. That's the bull case, right? We're going to examine every steel beam, every concrete pillar that supports this business. After that, we hand it over for a stress test. We're going to actively, and I mean actively, look for the cracks, for those hidden weaknesses that the market seems to be pricing in. A huge piece of that puzzle is what we're calling the weak guidance hammer. This might be the one data point that explains absolutely everything. And finally, of course, we'll deliver our verdict. Is this 5% pullback a golden buying opportunity, or is it a trapdoor just waiting to swing wide open?
Right, the paradox itself. Before we even start building the bull case, let's just establish the facts on the ground. On the surface, Korn Ferry delivered a quarter that most CEOs would, frankly, kill for. But the market's reaction tells us there is a major disconnect between the company's past performance and its perceived future. This is a classic battle, folks. Perception versus reality. And the billion-dollar question that every single investor has to answer right now is which one is right. So let's put the raw numbers up on the screen so you can see exactly what the company reported.
Just look at these numbers. They really do paint a picture of a company firing on all cylinders. This isn't some minor squeak-by beat. This is decisive. Let's break it down. Non-GAAP earnings per share, a key profitability metric everyone watches, came in at $1.28. That's a solid 4 cents ahead of what the analysts predicted. But the top line, the revenue, that's where the real power is. They brought in $725 million. Now, the street was looking for something closer to $695 million. That is a beat of nearly $30 million. It's not just a beat, it's a statement. This means they grew over 7% year over year, which is some real heavy lifting in this economic climate. And crucially, look at that bottom line. Net income margin expanded to 9.1%. They are keeping more of every single dollar that comes in the door. That, my friends, is operational excellence.
So based on those numbers alone, you'd think this company is an absolute fortress, right? Built to last. So now, it's our job to go inspect that fortress piece by piece. Let's forget the quarterly noise for just a minute. We're going to look at the underlying structure of the business itself. We'll examine this massive revenue engine, the expanding profitability, and all the forward-looking indicators that build the strongest possible bull case for Korn Ferry. We have to understand the core strength of this operation before we can properly assess any potential weaknesses. So let's start with the sheer scale of this machine. And this right here is the scale I'm talking about. $2.73 billion in fee revenue for the last full fiscal year. Let that number sink in. I mean, really absorb it. We are not talking about some small player that gets tossed around by every little market breeze. This is a massive, entrenched global consulting firm. And why does a number this big even matter to an investor? Because it signifies market leadership, it signifies deep client relationships, and it signifies pricing power. A company just doesn't get to this size without having a durable, in-demand service. This isn't just a number, it's a wide, deep moat protecting the entire business.
Now here's what gets really interesting. The business isn't just big, it's becoming a more powerful engine for profit. What we're looking at here is adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization. You know, investors love this metric because it gives you a really clean look at a company's core operational profitability. It strips out all the accounting and financing decisions. And here, look at this jump. From $408 million to $464 million in a single year.
That's 14% growth. So while the top-line revenue is growing at a really healthy clip, the underlying profitability is growing even faster. That's something we call operating leverage, and it means their business model is becoming more and more efficient by the day.
And this right here brilliantly illustrates the point that 14% EBITDA growth translated directly into margin expansion, climbing from 14.8% to a very, very healthy 17.0%. Now, why is this so critical? It's because expanding margins are the hallmark of a well-oiled machine. It tells you management has a firm grip on costs. It tells you they have pricing power in the marketplace. It tells you their services are not some commodity, they are highly valued. Listen, any company can chase revenue growth by spending wildly. It takes real operational discipline to grow revenue and expand margins at the same time. This is a clear sign of a high-quality, durable business.
So the crucial point here is that this strength isn't just in the rearview mirror. This number, $1.9 billion, this is the backlog of fees from existing contracts. You know what that is? That's future revenue that is already substantially locked in. It's the closest thing you can possibly get to a guaranteed pipeline of work. And it's not just big, it's growing, up a powerful 11% year over year. In an uncertain economy like this one, a growing backlog of this magnitude provides an incredible degree of stability and visibility. This isn't just a buffer, it's a reinforced steel wall against market volatility. It tells us that forward-looking demand remains incredibly robust.
Now let's move to the very foundation of this fortress. This is not a one-trick pony, not by a long shot. The business is built on 5 strong pillars, and each one of these is a major business in its own right. You've got executive search, their legacy business bringing in nearly $850 million, but then you have a massive consulting arm at over $660 million, professional search at over $500 million, and their digital and recruitment process outsourcing segments each contributing over $350 million. What this shows is intelligent diversification. An earthquake in one part of the market isn't going to bring the whole structure down. If executive hiring slows down, hey, maybe demand for digital consulting tools or interim professionals picks up. This diversity creates stability and resilience, a structure engineered to withstand pretty much any economic cycle.
Okay, I'll give you that. The bull case is strong, it's impressive. You've built a pretty solid-looking fortress here, with a wide moat, expanding margins, a huge backlog. You're right, the numbers don't lie. But that brings us right back to the central question, doesn't it? The ghost in the machine. If this company is so structurally sound, why on earth did the market panic and send the stock down 5% after such a stellar report? A fortress, you know, is only as strong as its weakest point, and the market clearly thinks it's found one.
Exactly. Every structure, I don't care how well built it is, needs to be stress tested. So now it's time to put on the hard hats and go look for the hairline fractures, the little signs of rust, the hidden weaknesses that might not be obvious from those big headline numbers. Because that's what professional traders are paid to do. They find the cracks before they become chasms. So let's apply some pressure and see what starts to buckle. You know, the first sign of trouble often appears at the edges, in the smaller segments of a business.
And here it is. This is from their second quarter report, so the period right before this latest one. Look closely. Consulting is up. Executive search is booming across every single geography. North America up 9%, EMEA up almost 11%. But then you get to their digital segment, a 2% decline year over year. Now, look, is a 2% dip in one of their smaller segments going to sink the entire company? Absolutely not. Of course not. But it's a crack. It undermines that perfect narrative of universal, unstoppable growth. It's the first sign of rust on the fortress gate, and it suggests that not all parts of the business are firing on all cylinders. It's a small detail, but Wall Street is a game of details.
You know, that little dip in the digital segment, that's just a surface-level crack, a bit of cosmetic rust. I'm far more interested in the foundation itself. Revenue and profits are one thing, sure, but they're accounting figures. Cash is king. Cash is the absolute lifeblood of any company. It pays the bills, it funds growth, it returns value to shareholders. And when I dug into their balance sheet, I found something far, far more concerning than a minor revenue dip. The real question isn't about one segment's growth, it's about the company's cash. So where did it all go?
This is what gives a skeptic real pause. On April 30th of 2025, Korn Ferry was sitting on a mountain of cash, over $1 billion. That is a serious war chest. Now, fast forward just 6 months to the end of October, that pile has shrunk down to $761 million. That's a drop of almost $245 million. $250 million vanished from their balance sheet in just half a year. That's not a leak, that's a hemorrhage. Now, to be fair, there could be good reasons for this. Maybe acquisitions, major investments, big share buybacks. But a cash burn of this magnitude raises very serious questions about their cash flow. It suggests that while the income statement looks fantastic, the cash story might be much, much weaker. This is a significant crack in the foundation.
That cash burn is a legitimate concern, and it's a metric we absolutely need to watch going forward. It's a yellow flag for sure, no doubt about it.
But I don't believe it's the kill shot. I don't think that's the specific reason the stock dropped 5% on earnings day. The market can forgive cash burn if the growth story is strong enough. No. I believe the market's violent reaction came down to one single thing, and it's the most powerful force on Wall Street: future expectations. It wasn't about the Q3 they just reported, it was about the Q4 they're about to have. And this is what we call the weak guidance hammer.
And right here is the smoking gun. This headline from investing.com says it all. It nails the paradox perfectly. Weak guidance despite beating estimates. This is the absolute key to understanding the market's psychology. Wall Street is a forward-looking machine. You can post the best quarter in your company's entire history, but if you even hint that the road ahead is getting bumpy, the market will punish you, instantly and without mercy. Past performance is no guarantee of future results, and traders sold off the stock not because of what Korn Ferry did, but because of what management said they were going to do next.
So let's define weak, because this is where all the nuance lies. On the left, you see the company's official guidance for fourth quarter earnings per share, a range between $1.34 and $1.40. Okay. On the right is the consensus, what the market was expecting, $1.37. Do you see the problem? The midpoint of their guidance, $1.37, is exactly the consensus. They didn't guide above what the street wanted, they just bracketed it. To an outsider, that might seem fine, even reasonable. But to Wall Street, it's a massive red flag. It signals a lack of confidence. A truly bullish company guides decisively above expectations to show momentum. By merely meeting them, management is implicitly saying, this is as good as it gets for now. That is not a message that inspires confidence, and that was the hammer that cracked the stock price.
Okay, so we've laid out both sides of the ledger. We've built the fortress, and we've admired its strength and its design. And then we've run the stress test, looking for every single vulnerability. So now it's time for the verdict. We have to weigh the solid, tangible, operational performance of this business against the market's clear and present anxiety about the future. We need to decide whether that 5% drop was an emotional overreaction, a chance to buy a solid company on sale, or if it was a prescient warning sign of real trouble ahead.
So let's put it all head to head. The foundation, the bull case, it's built on indisputable facts. A powerful Q3 beat on both revenue and earnings. A growing backlog that gives them a clear line of sight into future revenue. Expanding profitability, which proves their operational excellence. And a diverse revenue base that provides stability and resilience. But then you have the cracks, the bear case, and it's all about fear of the future. The guidance wasn't a miss, but it was perceived as weak and uninspired. The cash pile is shrinking at an alarming rate, raising very serious questions. The digital segment is faltering, which dents that perfect growth story. And all of this has created a storm of negative market sentiment. So the ultimate question is, which side of this ledger carries more weight?
And that's the bottom line. Our analysis shows that the core business, the actual operational fortress of Korn Ferry, it appears to be remarkably strong and well-managed. They are executing at an extremely high level. But they are operating in a market that is utterly terrified of the future. The skepticism isn't about the company's current health. It's about what might happen next quarter or the quarter after that. For any investor, the crucial decision is whether you believe the company's proven operational strength will ultimately win out over the market's forward-looking fear. Is this an overreaction you can profit from, or is the market smelling smoke before the rest of us even see the fire?
And that leads us to our final question, the one we want to leave you with. Is the nervousness around Korn Ferry's guidance an isolated issue, a company-specific problem that makes this a durable structure now temporarily on sale? Or is Korn Ferry, as a key bellwether for corporate spending and confidence, the canary in the coal mine? Is their cautious outlook a warning sign not just for this one company, but for the health of the entire global consulting industry and, by extension, the broader economy? That's the billion-dollar question you have to answer before you consider forging this stock into your portfolio. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.